Hey guys, John Paulamy here, Actionable Intelligence. And today I want to talk about mean reversion and what I see happening and why I'm so ecstatic and anticipating a mean reversion into energy and away from tech. I wanted to show you this chart. It goes back to 1995. It shows the um, basically tech versus energy, and it shows you that when tech is in favor, like it is now, which is the gold bar, that energy is out of favor. And energy is extremely out of favor right now, and specifically oil and gas. Why? Well, many reasons. We've had an extraordinary run in the shale business that opened up all kinds of new production in shale oil and shale gas. That gave us a 10-year run of lower prices. However, there's geological and financial components to that no longer exist, that are not going to allow that bounty to continue. And conversely, we see this display of tech where everything tech all the time. And what I'm trying to tell you is that we are seeing some of the most extreme um, divergence. And when we have seen this in the past, as one person calls it, the alligator jaws, they snap shut. You saw that happen back here, and it kind of happened a little bit here. And then, these things get out of whack in proportion to um, their contribution to the economy. We saw this before. So what I'm trying to tell you is with tech, that's what everybody's into. It's all we hear about. The market keeps going up. We have a situation where there's only like 4 or 5 stocks that are driving the indexes higher: Apple, Google, Amazon, and I can't remember. But it's not that, it's concentrated, and a lot of other companies are out of favor. And energy companies are out of favor, even though we need energy for everything that we do, because of ESG, and like I said, this prolonged period of lower prices, which just hasn't led to decent returns. And one of the things that really gets me stoked is, energy right now as a percentage of the S&P is at its lowest point in 30 years. So basically what we're saying is that, back in 1980, when oil prices really took off after the oil embargo in the 70s and the energy crisis in the late 70s, at one time energy was 30% of the S&P. Okay, and you had companies like Schlumberger, who I said is one of my public picks. It was one of the darlings of that time. Okay, it was by capitalization the 4th largest company in the S&P. So, and right now it's out of favor. Okay, it's selling at historical lows. Now it should, because its business is horrible. But will its business remain horrible? Will we not need oil and gas? Will we not need to go out and explore? Will we not need the services of an oil field services company like Schlumberger with decades and decades of experience and technology and the things that they do? We just don't need that anymore. So that seems to be the zeitgeist, the pervasiveness. So what I'm suggesting to you is that when these things get this extreme, they inevitably mean revert. Okay, now people will say, well, this is only 30 years. Things have changed. It's different this time. It's never different. It's never different. That's what I have learned long and hard. It's never different this time. There's a lot of people that don't have a lot of experience or wisdom or talk in their book or don't really know what they're talking about that say that, but there is nothing new under the sun. And I wanted to point this out. One of these companies that's in the news today is Apple. It's now, by market cap, a $2 trillion company. Okay? It's worth $2 trillion. The entire GDP of the United States is 22 or 23 trillion. So basically, Apple is 8 to 10% of the entire GDP of the United States, the worth of the company. I mean, it's hard to even visualize these numbers or conceptualize what $1 trillion is. But that's where we're at. And you see that this basically just price, after the coronavirus, I mean, this thing was already overvalued in my view back in February, March of this year, okay? And then we were already in a bubble, in my mind. And then we had the coronavirus deal. The Federal Reserve turned on the stimulus and the pump priming, and look what's happened. The price has, almost doubled. Okay, this huge value in like 5 or 6 months. And this is, I could put chart after chart up here that's exactly the same. And what people don't seem to understand is when you buy Apple, this is not flipping baseball cards or just a symbol on a screen. This is when you buy shares in a company, you are buying a proportional piece of that company and a claim on the future earnings streams of this company. And the point is that history has shown us that when extreme valuations happen in these companies, it seems that justifications can be made to why it's like that. But it's never that way. Something comes along and changes it. I don't know. Maybe this thing ends up being worth 3 or 4 trillion. There's no telling. But I can tell you one thing right now, that when valuations are this stretched, inevitably there's a change. And so what I wanted to say is, we get into this magical thinking and this necessity of belief that must be maintained to keep these valuations. One of the reasons we have this concentration in these tech stocks, these 4, 5, 6 names that carry the entire market, is because they have very large market caps. And so a lot of investing is done passively via ETFs, and people just put money into a 401k, it goes into an ETF or it goes into a fund. And these things are structured such that there's no active investment management going on. No one's going in there and picking stocks because passive investing has worked. And how does passive investing work? So this ETFs, like a technology ETF, is going to show you, or just an S&P, 500 ETF is going to be weighted by market cap. So the larger the market caps of the company, more new money that comes in goes and is distributed to those higher market cap having companies. So it kind of feeds on itself. It creates a self-reinforcing feedback loop where more money comes in. You put $100 in, and most of the money is going into these large cap tech stocks, which increases their valuation, increases their dominance of the index, and as new money comes in and the index goes up, more money's drawn in, and it feeds on itself like a fire until something comes along and changes the market perception. I mean, we've seen this in the past. We saw this in the tech wreck in 1999, 2000. So the Nifty 50, I read about that. I wasn't around for that. That was in the 70s where they had these stocks that the valuations were so extreme and they were conglomerates and they were going to do this. I've read the stories, Gerald Tazai and guys like that, and they could do no wrong. And you know what? Eventually the perception and the view changes, and then the valuations came in. And what you will find during these episodes of these manias or these bubbles, you will see all kinds of justifications for extended valuations that are created by the media, by managers, fund management people, this type of thing. It's a new era. It's all about tech. We're all going to work from home. That's why we're all going to shop on Amazon. It never seems to work out that way in the end, but all kinds of justifications are always created to try to explain why the valuations make sense, these extended valuations. Then these companies turn into what I call must-own companies. You must own these, right? Because if you don't, you're going to get left behind. And so people say, why should I even be an active manager? Why should I even pick my own stocks? I'll just put money in an S&P fund because it just keeps going up. And then you get concentrated into these 4, 5, 6 companies. And it feeds on itself, and it goes until the music stops. And that's the deal. I can't tell you when the music stops. And I will tell you, though, it will stop eventually. And there is nothing new under the sun. So I'm looking for mean reversion. I know that this is going to happen. I cannot tell you when. That's the trick. That's the question. If you think, as a novice investor or somebody that doesn't have a lot of experience, and there's quite a few people that listen to this channel that don't have a lot of experience, and you're riding high on Robinhood and stonks never go down and you're killing it, let me tell you, it's going to end. And the people that make the real money over the long term are the people that buy value. It's the price that you pay for a security that determines your ultimate return. You can be on a heater for 3 months, 6 months, or a couple years, and there are quite a few people, but they won't that are killing it right now, but they will not be around long term. Something will come along that no one thought about, and the perception in the market will change, and there will be a rotation out of what's hot to what's not. And when I see this extreme, I mean, this is how extreme it is. I mean, that's where the value is. And like I've said, when success leaves clues, and the successful long-term investors that, Druckenmiller, Howard Marks, Buffett, it's all about value and the price paid for a security. That's what determines your return. So I don't know if you agree with me. You can tell me in the comments, but this is what I'm trying to tell you. This is why I'm so stoked on energy. Has it worked? No. Do I think it will? Yes, I think we will mean revert. I think that ultimately the worm will turn for reasons that I've articulated in other videos. But that's not the basis of this video. I just want to show you how out of whack this market is, and that where the true value really is, and that we have a historical narrative that in fact these kind of wacky valuations do mean revert. So that's it for this video. Just wanted to get that out there. Thanks a lot for listening. We'll talk to you next time.